Let's talk to Shaun Richards. He is NotAYesManEconomics. Shaun, very good morning to you.
Morning.
Inflation with a capital I, it seems to be on everybody's tongue this year. 10-year money in the US driving stock markets down. Everyone looking for the inflation numbers, getting the headlines. We've got volatility. What's going on?
Well, I think that there are various issues here. We did start the year with some commodity price pressure. For example, the oil price went to $70 in terms of the Brent crude benchmark. So there was that, copper, a few other issues if you look around the metals and so on, that indicated that there was some pressure from there. Somehow or the other though, about a month later, sort of stock markets fell and then everyone's blaming the price pressure. But actually, if you look around, some of that's gone away now. Brent crude more like $62, $63, not 70. So it's I think got the blame for the stock market fall, and I'm not really sure that works, because if you say look at the UK's numbers yesterday, inflation was 3% again, so more or less the same. If you look at the RPI, that dipped a bit. So we're passing the sort of, if you like, Brexit vote driven phase, and if you look at the producer price numbers, I think UK inflation will dip back towards 2% later this year, depending what happens with other stuff. People are expecting, and again, this is very dangerous because they don't always get this right, but say the US inflation numbers later will be a bit lower. So where is all this inflation then that's going to drive it? And there's the problem for that line of argument. If we stick specifically with the UK numbers, people may not be aware that there's an attempted swerve going on. The new preferred measure that they say puts in housing costs is at 2.7%, so a lower number. This is the theme here.
Okay.
Except to get that lower number, they put in imputed rents. For those that are unaware what this is, if you own your own house, don't matter if you buy it or have a mortgage, it's the same category. They don't put in things like house prices or interest rates. They decide you pay yourself a rent, which you don't. So there's the next question, where do they get it from? Well, they go and look at people who do pay rent. And even so there's an obvious issue here of a sort of fantasy where they put that in. Then they have actually had a lot of trouble measuring rents in the first place. They don't get a direct feed into them. They take somebody else's numbers, and that's gone wrong once already. But however, once you've done all that, you get to yesterday saying that rents in the UK are growing at 1.1%. So that's what's bringing that inflation number down, lower than the others, that there is very little rental inflation in the UK as they measure it. And that then, to my mind, brings a really big problem. Because in recent years, what's been the problem with the UK? Expensive housing. Across a lot of it. Except when you put it in the inflation measure, it's reducing it.
Right.
It's insane.
Okay, that sounds madness to me.
But that's what's being pushed, and it is a big problem. Because each time they bring in what are these so-called improvements to inflation measurement, always gets a lower number. Sometimes that's fair enough, but a lot of time they're forcing it in.
So in terms of economics and stock markets, how important is inflation? Everyone says, you know, we've got to hike rates up because inflation, you know, there's this horrible thing sitting in the background, this big cloud.
Well, yes, but the only place that's really doing that's the United States. We're not.
But a bit of inflation's healthy, right?
Actually, I'm not really a buyer into that, because as we stand now, the problem is that wherever you look, wage growth isn't very much. So once you start getting inflation, it grows above.
But the wage growth in the US, unless they adjust the numbers next month, was at an 8-year high, right?
Yeah, that was a better number. But even so, that was 2.9%. If we jumped into Doctor Who's TARDIS, went back 10 years, in the same circumstances, we'd be expecting it to be 4 or 5%.
Right, okay.
Inflation would be 2, going to 3, let's just say, but it would be 4 to 5. So the real wage growth would be 1.5%, 2%. Similar numbers for the UK. That's what, cruising into the current mess, everyone thought, except it's not like that anymore. And when we do get growth or inflation, so far, wages don't really follow it. So last month, number in the States, 2.9% growth, average hourly earnings. But that's one reading out of a lot, and we've had these before. For example, in the UK, we've had various times where wage growth's gone above 3%. Bank of England in particular then says, oh great, it's going higher, except it then goes back down again. And there doesn't appear so far, again, to be any pattern between inflation, how the economy's doing.
Right.
That.
Okay.
So it's a mess. And the inflation problem now is, when we get it, actually Here's the switch. It's much worse for the economy than it used to be if wages don't follow it, because people are worse off, and in effect they spend less, sacks the economy down. The picture's changed quite a lot, unless we come to some future where wage growth comes back again.
Well, that's the million-dollar question, right?
Yes, and in all of the economic models, and this has been a big flaw of the credit crunch era, it should have done that 5 years ago.
Yeah.
I might be exaggerating, certainly 4 or 3, but it hasn't. And yet they keep churning out the same old lines. Output gap, wage growth will come in. Bank of England, one of the policymakers, Gert Jan-Verliege, I hope I've said that right, was at that again earlier this week. But where's the evidence? Occasional survey, yes, but in the official numbers, there's nothing there.
Shaun, on that conundrum, we have to leave you. Thank you very much for your time.
Thank you.